Adobe stock is down 50% from all-time highs, and is down since February 2024. Is down 45%, and we have bought it. This is, in my opinion, a very good buy right now. And as you can see here in my eToro portfolio, which is public, I have increased the size of my position, which was already the number one position in my portfolio, but now it has ballooned out of proportion to about 17% of my total portfolio here. Let's take a look here. Let's refresh. Yeah, I added today as it reported earnings. Today, Adobe stock is not down after reporting earnings, which is rare. Last, I would say 5 or 6 times this stock has reported earnings, at least 4 times from what I can remember. So we're here in TradingView. Let's take a look at the earnings release. We are here in September 2023, so 2 years ago. On this day of reporting earnings, it went down 5%, more than 5%. The next earnings call went down 4%. And then it went down 10% in March of 2024. Here I had a huge rally. June 2024, it went up 12%. And in this period, I would say more than 20%. Let's see, the next one is going to be down 3%, down 16% in December 2024, so 9 months ago. This one is down 12%, again, big drop, and down 6% in the last earnings call of June 2025. So today, it has not gone down. Well, actually, it gapped in the after hours, and then it crapped. Gap and crap for about 5%, and slow recovery. I think this is at least a positive sign, okay? Breaking even, I mean, yeah, I mean, to me, it's very obvious that the stock price is bottoming. I think it's just trying to retest this level here, 333. April, it was bottoming around the same kind of price, 343, 340. Yeah, but in terms of valuation, I think we're going to take a look at all of the numbers, but in terms of valuation, the stock is getting absurd. But yeah, if you would just take a line and draw it here, I think you would see that it's just hitting the head. Let's just make a simple drawing here. I cannot draw the line, but yeah, let's try. It's not a very straight line, but you can see that it's just gonna hit its head around this area, and probably it's not the end here. It's probably gonna zigzag a bit and then break out. But yeah, anyway, I'm buying this and holding it for at least 2 years until the trade is gonna be complete and is gonna satisfy me. I don't really care about technical analysis, but I know how market works. I know how trends work and how long they take, and when they shift and a new trend appears, going from a downtrend to an uptrend. It doesn't just happen like that. For example, this is a violent downtrend. It created a violent upside, and now it's been a lot more calmer in the swings, and a lot more time has passed. So as you can see, violent ups and downs in this last downswing. It's not like the first one where it just went down by a lot in a short period of time. But yeah, it's just going to slow down. It's going to continue to slow down until a new trend appears. And it doesn't have to be like this one going up 600%. It can just go up normally by 10, 15, 20% each year. It doesn't have to go crazy anymore. This is a very mature company. But yeah, until it reaches all-time high, I'm hoping to double up my money. And I think this will reach all-time high prices again. Maybe not in 2 years, but a couple of years at least. Let's take a look at the numbers. Income statement here. Revenue, this does not pay a dividend. It has a market cap of 150 billion, let's say. PE ratio 22, forward PE 15. This is always great to see, because it means that the fundamentals are improving. So whenever the forward PE is much less than the actual PE, it means that the earnings will improve quite a bit in the future. So you always want to see lower and lower PE ratios whenever a stock price is going down. That's exactly what the type of situation that you want to put yourself in. So let's take a look at the revenue growth. As you can see here, very smooth and consistent. High growth, double-digit numbers across the board. let's see here. It had a lot of high growth before 2020. It was running in the double-digit numbers for more than for about 4 years. Let's just say 5 years with 2021. I mean, this is just crazy. Also, the 2015 is a 15% up, and then 2020 is also 15% up. So it had a period of about 6 years where it just grew, 7 years where it just grew by a lot in terms of revenue, and then cooling off here, but still double-digit growth rate, low teens. Let's take a look by quarterly at the numbers, at the revenue. As you can see here, there is no cyclicality at all. Very smooth, just going up. I mean, 45-degree angle. Yeah, it doesn't look like it's just gonna drastically slow down anytime soon. I think it's just gonna add more and more to this number as the years go by. I mean, Adobe, one of the highest quality companies that I have ever owned and that I have ever had the opportunity to own, because these type of occasions come very rarely. Back in 2022, I was invested in Meta, which was a bigger opportunity, and I missed Adobe, but I am glad that the downtrend continued and now have another opportunity to get into the stock and make some nice gains on the upside when it recovers. But yeah, let's take a look at shares outstanding. As you can see here, it's accelerating the share buybacks. It retracts more and more shares from the float each year. And in terms of percentages, just look at this. It used to be buying back around 1% each year. And since the stock price has been dropping, they were able to retract more in terms of percentages. But also, they were allocating more capital to share buybacks because they become more and more profitable with time. So trailing 12 months, we're looking at almost 5% in buybacks. Maybe by the year end, we're going to see this number a bit higher here. Maybe, hopefully more than 5%. I mean, if you take a look at Adobe and what a high quality business it is, and you're looking at minus 2%, minus 2.5, minus 2, and then minus 5%. I mean, that's just going to be crazy. I'm going to be buying with both of my hands if this goes sideways for a little while longer. Maybe I would say if this price remains around 350 for 1.5, 2 months, maybe until December, I'm just going to probably go all in. I'm going to just add more and more to it. I'm probably going to sell my Pepsi stock and come back to it whenever I can and just allocate it to Adobe because it's getting ridiculous at this point. Let's take a look at gross margins. More than 80%. Of course, this is a software company, but it's at 89%, okay? Very, very few software and very, very few technology companies exist in this world that have 89% gross margins, and they are bringing this type of huge revenue. I mean, more than $20 billion a year. So 10 years ago, they were hovering around 85, and they have been improving with time, as you can see. 85, 86, 87, 88. Now we're sitting at 89%, okay? So price is going down. Margins are slightly trending up. I mean, you cannot say that they are improving by a lot because it's just, I mean, they were already very, very high. But yeah, 89% is extremely high and excellent. These are pristine margins, okay? This is pristine level of, I mean, the management is great. The talent and the management, the employees, this company is amazing. I don't know. I'm very glad to have had this opportunity, and not just in my eToro portfolio here. I'm allocated with a large amount, 20% invested and 17 currently value, but a lot of my personal wealth in investments is allocated in Adobe stock, and hopefully I'm just gonna double up my money really quickly here. I mean, I see no risk to the downside with this stock. Look at this operating margin, 36%. Amazing. It's really great. I mean, yes, it could be higher. I've seen higher. I have some stocks that are higher, but still, Adobe needs to invest a lot in R&D and marketing. They invest about $5 billion in sales and marketing each year from this 23 billion that they bring in, and they put in around $3 billion in R&D. So 36% is still very, very good. Profit margins, 30% here. Again, since 10 years ago, all of the metrics are improving. I mean, look at this. Since 2015, they were sitting at around 19%. Now they're basically double, 37%. Free cash flow margins, 41%. I mean, that's just ridiculous. Yeah. So a lot of green flags, and not just slightly green. I mean, dark green flags. Okay. All of the margins are very dark green flags. Shares outstanding, shares change year on year. Trailing 12 months is a dark green, and then last couple of years are all normal green, I would say. But yeah, I mean, look at this. It's just gonna accelerate as the stock price goes down. They buy back more and more and more shares in terms of percentages. This is exactly what I want when I'm allocating a huge chunk of my net worth into a single stock. Okay, I want no risk at all, and I want things to happen quite quickly. I don't expect to double up my money extremely fast. I just expect this to go up from here in a short period of time. I don't expect this to remain at this level for much longer. So that's why I think it's time for me personally to allocate as much as I can into this trade, because it's been brewing in my portfolio for a not a very long time, but I would say more than 9 months, which is, yeah, okay. You can be invested in some stocks for a longer time before they start working out, but usually I tend to buy very low. I tend to buy stocks that are very low in price, that have crashed a lot. For example, this Novo Nordisk stock, I'm already up 10%. ASML crashed, I'm buying it up 20%. UNH, this is a very recent buy. I mean, what are we talking about? 2 months ago in August. So I'm just buying when things go vertically down, and they go down by a lot. But I guess this Adobe stock has, you might say that it's down a lot from all-time highs, but then when you show me this graph, I'm just gonna tell you, for me it looks like it's going sideways, because it is. I mean, just it's zigzag, zigzag, up, down a lot, up a lot, down a bit less than last time, and now it's time to break out from here, because I don't see any possibility that this goes down, that it breaks out to the downside from here. It makes no sense, because let's just take a look at the numbers further, and you're gonna come to the same conclusion. Cash and cash equivalents. Last year they were sitting on around 7 billion of in cash and equivalents. Now trailing 12 months around 5 billion. Let's just take a look here. Shareholder equity going down by a bit. I don't like to see this, but it's not like a red flag or anything. Used to be slightly green flag. In a software company with these type of margins, I don't really care about shareholder equity. This is not some kind of industrial stock where the margins are very low and the company has a lot of debt, and it can go bankrupt. So I'm not looking to have a lot of equity. I don't really care. Total debt 6 billion for this company. I mean, with the net income that they bring in a single year, they can just pay this off. So it's nothing basically. Net cash debt slightly negative here by about 700 million. I mean, this is also nothing, but we would have preferred to see this in a lot higher, like in a couple of billion in net cash positive, especially now at this price point. But why? Because they are able to do more buybacks, more substantial buybacks, if they have a lot of cash on hand. But it's not like any green flag or anything like that. Net income, let's take a look here. 2015, 600 million. Trailing 12 months, $7 billion. Wow, that's, I mean, for, I don't know. I don't know what to say. Market cap of 150 billion, and they're bringing in a net income of 7 billion. That's a lot of money. And as you can see here, again, it's very smooth. A bit of an anomaly here in 2020, also here. Let's just ignore these 2 quarters here. I mean, we can just draw a line here, and it's like 40% degree angle going up. So that's great to see. Very smooth, very consistent. Stock-based compensation, 1.9 billion is a lot. Okay, it's a lot, but still less than 30% of the net income, which for a software company, it's great. For a very high quality company in general, and software company that has these kind of metrics, I could maybe compare it to something like Zoom Communications here. Zoom Communications has also very high margins, gross margins, not as high as Adobe, and not as consistent, and it's just not the same high quality. But yeah, it has high margins overall. But if you take a look at the net income here, it's bringing about 1.2 billion, and stock-based compensation is 850 million. So really bad. You don't want to own this at all. This is not something I would ever want to own, even though the company looks really good on paper and it's profitable, but it's just going to dilute you to death. I mean, this is not a shareholder-friendly company. So I'm going where the management team and the CEO and the company is looking not only to improve their product line and their services, but also try to return value to me as a shareholder over time. So stock-based compensation, is it high? Yes, but not extremely excessive, not excessive at all for this type of company that is basically at the very high end in terms of quality. Less than 30% of net income, that's great. I mean, this company is very, very profitable. They do pay their employees and management a hefty amount, but they don't need to go crazy overboard, and there's enough left over for us. Repurchase of common stock, let's see here. More and more and more each year. I mean, this shows that the growth is very real, and their purchasing power is very strong here. They are able to buy back a lot of shares. Last year, they bought back $10 billion. Okay. Trailing 12 months, $12 billion. They might end 2025. Let's just say 12 billion for 2025. So in last 2 years, they bought back more than 20 billion compared to a market cap of 150 right now. So that's a lot. Okay. That's just a lot of money poured into stock buybacks, which is great for us when we are trying to go all in at these price points. Let's take a look at the market cap by quarter and see where it was in the past. It did hit around 320 billion, September 2021. So 4 years ago, since 4 years ago, it halved. It did hit a low that was higher before, and you might say, how come it was higher in December 2022? Because it had 159 billion back then, and now we're at 148 billion. And when you take a look at the graph, the price was much lower then in 2022 than it is now. Well, that's because each share becomes more valuable with buybacks. They are buying back shares. I mean, since that bottom until today, we are up 27%, but in terms of market cap, we are lower. So what's going on here? Clearly, yeah, the buybacks are so substantial, even though it just passed only 3 years since then, about 2 years, March, 2.5 years, let's say, okay? That's crazy that they were able to impact with buyback so much, the share price. But yeah, as you can see, this is a very green flag for us. We want to buy low. We don't want to buy when it's high, okay? You don't want to buy here. You don't want to buy when it's going up by a lot, almost vertically, when it's going up exponentially. That's a very bad deal for you. You're just going to underperform the market. You're going to have massive swings going down 60% or whatever. Why? Because you bought it at a very high valuation. So when the interest rates started to go up, something that like Adobe that was very, very highly valued, and we're going to take a look at the EV to EBITDA and other metrics, and you will see how very highly valued it was. So companies like this, when the interest rates go up, they're just going to pop. They're just going to completely deflate and have violent swings to the downside, of course. And yeah, you're just going to have these swings in your portfolio, and it's just not going to be good for your mental health. I mean, you don't want to experience these swings, no matter how crazy and insane you are, and you might end up making mistakes such as selling when it's going down and not buying. So I always buy at the lows, okay? I always buy when it's low, very low. I do not buy after it's gone up. I just don't touch it. But yeah, let's take a look here at the PE ratio over time. So right now it's sitting at 22. A couple of years ago, it was sitting at 60 when it started to pop. So very, very overpriced. You do not want to buy stocks at 60 price to earnings, okay? You're just gonna you're gonna get hit in the face, and you're gonna be hurting a lot in your home alone. You're gonna look at the price in your account and see a massive sea of red. Forward P 45 back in 2021. Now it's at 15. 15 forward P. That's ridiculous. Okay, that's insane. That's absurd. EV to EBITDA, 47 times. That's very richly priced. Now we have shaved almost 70% off of the valuation. This is not extremely dirt cheap levels, but it's in my territory for the metrics that the company has, for the quality that this company has. This is dirt cheap in my book. It's not 10x EV to EBITDA, but it's pretty much very close to being dirt cheap. EV to EBIT, same kind of story. Return on capital invested. Let's see here. Going up and up and up over time. This is not a metric that you are not looking at the revenue graph here. You are looking at how efficient is the management with the money that you give them, and what type of return they can bring you each year. 27% trailing 12 months. return on capital. So that's crazy. It's just going up and up and up in percentages, and we are at all-time high. I mean, that's, I want to buy this more. I don't know what to do. I'm kind of conflicted about completely selling PepsiCo and just adding it all to Adobe. And maybe I'll come back to PepsiCo because PepsiCo is not going to move so fast as Adobe will. ROCE, return on capital employed, 9%, 15%. I mean, these numbers are already very, very high numbers from 10 years ago, okay? 43% is absurd. Is extremely high. I have like maybe one other company that is at these levels. Qualys. Let's take a look at Qualys. Yeah, not even Qualys, 33%. Yeah, I don't have any other. Maybe Fortinet. Yeah, not even Fortinet. Bit of an anomaly here. Over time, return on invested capital usually does not sit higher than return on capital employed. But anyway, let's go back to Adobe. Yeah, this is absurd. I mean, this is ridiculous. This trending up and up. I mean, what can I deduct from this by looking at this graph? That it's just gonna improve over time, or at least just maintain this level. I mean, if you showed me this graph, I mean, what am I gonna say? That it's just gonna go down from here? No. I mean, the management is great. Now, we come down to my favorite valuation ratio metric, which is FCF yield. It is sitting at 6.5%, more than double than the S&P 500 average. The S&P 500 right now is less than 3%. The actually maybe 2.5%, because a lot of stocks have ballooned out of proportion within the S&P, like Palantir and Nvidia and a lot of companies like that. But anyway, FCF yield 6.5%, decade highs. This is great, a great buy right now. Makes me want to buy with both of my hands. So let's take a look at my portfolio here. What can I trim? Actually, maybe I'll just trim a little bit from everything and just buy Adobe. I mean, yeah, I like the price action for today after the gap and crap, and now it's slowly creeping up. I don't know, 8% in PepsiCo. Maybe let's bring it down to like 7%. Let's bring down Novo Nordisk to 5%. SML, I don't want to sell that. Qualcomm, I don't want to sell. United Health, I don't want to sell that either. Yeah, and the rest are insignificant positions. I don't think I can get much more. Maybe 1% more by just trimming a bunch of stuff in here. But yeah, a lot of the trades have not been completed yet. Maybe I'll trim Alibaba because I made a buy earlier this year for about 3% of my portfolio, and it's already gone up. I bought when it went down. I bought at 104, and now it's up almost 50%. So I might just trim Alibaba and go with Adobe here. But yeah, let's just make it 25%. I'm gonna pause the video right now, make some buys on my phone, and refresh this page. Okay, so let's refresh now. We did trim a couple of, so now we're at 20% invested. We trimmed some Alibaba. I took some profits from here. I think it's correct. And then I trimmed PepsiCo a bit, trimmed Novo Nordisk a bit, and some other software companies that I had here, CRM, Paycom. And yeah, I normally don't do this, but I just think today is very relevant. It's the first day that it didn't go down. I just think it's like very close to the bottom, if not this is the bottom. And yeah, I added 3% more. So yesterday, what's going on here? So now today I added 3%, and then during this video I added 3% more. I was prepared since yesterday, since I saw the after hours move. I was prepared. So as soon as the market opened, I made this purchase at 347, and then during this video at 350 I made another purchase. So my average open right now is 371. Not too bad. So right now we're just gonna sit on everything. We're not gonna touch anything. I think I really like how my portfolio looks going forward. Yeah, nothing to complain about. Alibaba looks really strong. I'm gonna keep this as a top position of mine for the next years to come, because I just think it has a lot of runway until it reaches about $1 trillion or so, and it can in the next few years. I mean, look at this. It's just getting started. Yeah, we made really nice gains and we took profits already, but I want to be mostly invested in Alibaba in the next few years. But yeah, once the next move, what are the next moves? If United Health somehow reaches 450 or so, I'm looking to trim down my position by quite a bit and then allocate to something else that hasn't moved in my portfolio. Maybe MSCI, maybe something else. Maybe Lululemon if it keeps going down, because next video I'm going to be making is about Lululemon. I have increased my position in Lulu as well. I think it's very, very undervalued and cheap right now, and it's a great company. But yeah, that's pretty much my plan for now. There will be separate videos talking about portfolio strategy and management and how to diversify across different sectors and when to buy, what to buy, stuff like that. Things that type of videos that do not focus on individual stock or analysis on the net income statement. But yeah, that was it for Adobe. Probably the last video on Adobe this year, and we'll see what's up.